When you look at commodities basket, right now it seems like a tale of two sides. On the one hand, we have precious metals, both gold and silver. They are shining bright if you see the way the prices have moved on both these commodities. Both gold and silver prices, they've bounced back from the kind of lows we've seen in the month of March. In fact, gold prices are up almost 9% on a year-to-date basis. And while gold is on this tear, crude oil prices, they're coming under severe pressure. The turmoil in global banks sparking fears of a financial crisis, and this could go on to impact demand. Brent crude has recovered some of the losses, and we've seen it trade around $72 to the barrel mark. But the question is, could we see crude slip even further? And is gold back to being that safe haven for investors in all this volatility? We'll discuss this with our guests tonight. But first, my colleagues Sharath and Shomit are joining us to break down the situation for us. Let's first go across to Sharath. Sharath, do tell us exactly where we stand as far as the fall in crude oil prices is concerned. And of course, we'll discuss the rise in gold as well. But to you, Sharath, first.
Well, yes, the international COMEX gold prices has gone up above the $2,000 per mark per ounce, and the important thing is the highest level seen in almost a 1 year itself. Now, the pre-COVID levels, if we see, the highest number was almost $2,075, and as on August 6, 2020, on a closing basis, the number was coming in at $2,064 per ounce. But the important thing is what is the main factors driving it, and of course the safe haven appeal is there, and also the store of value. But apart from this, an interesting development is also there, that despite the regulatory interference coming in to save the financial institution, still the traders are actually bullish on the gold's demand, and they expect 3 to 4 months of significant rally coming in the gold prices. Apart from that, also the macro numbers such as the dollar index as well as the 10-year treasury yields, they have also actually corrected, and from the March lows itself there has been double-digit returns coming in for gold as well as silver. Now, apart from the returns as well, the Indian domestic gold prices, that is something to talk about, and that itself has touched or actually breached the 60,000 per 10 gram mark, and this is the record levels coming in for the month of March itself. The domestic prices went up 6%, that is almost, you could say, roughly 5,000 rupees in the month of March. And we spoke with dealers and they have stated there are huge discounts coming for spot buyers for the dealers in India. But the most important thing happens is on March 21st when the Fed meet is starting, and they are expecting that there will be a reduced aggression when it comes to hiking rates, and overall they are expecting a 25 basis points hike, while earlier it was estimated it would be a 50 basis point hike.
Well, if you see Brent crude, they are at its lowest at a multi-year low, and the reason behind this is the demand concerns that are evolving globally, started from the US market because of the banking crisis that we have been seeing. Along with this, the OECD inventory is also at a 5-year high, which means that there could be more supply or more inventory in the market. So the demand-supply dynamics is not in favor of crude oil prices, and that's the reason we are seeing such kind of a fall. Now, India is a clear beneficiary of this because India imports nearly 85% of its crude requirement, and every $10 per barrel drop in crude prices benefits or lowers the retail inflation by around 50 to 60 basis points, and the wholesale inflation comes down by around 125 to 135 basis points. Also, the current account deficit narrows by around 14 to 15 billion US dollars, that is nearly 0.4% of the GDP. Moving on to the companies or the sectors, oil marketing companies. Now, this is one sector that is expected to see a mixed reaction here, because lower oil prices does benefit the marketing segment of the oil marketing companies because the marketing margins do rise. But whenever we have seen such kind of a sharp drop in crude prices, there are heavy inventory losses that are also been borne by this oil marketing companies. When it comes to oil explorers like ONGC and Oil India, fall in crude prices is negative because crude is the main product, and fall in prices means that the realizations will be impacted. According to analysts, every $5 per barrel drop in crude prices impacts ONGC and Oil India's EPS by around 7 to 12%. When it comes to paint, 40% of the raw material cost is either crude or crude derivative, so a lower crude prices definitely boost their margins. When it comes to aviation sector, their major cost is fuel, and 40% of the fuel is nearly 40% of the total cost is nearly fuel, and lower oil prices means lower fuel prices for airline companies. Similarly, for lubricant manufacturers, tire, cement and specialty chemicals, nearly 40 to 50% of their costs are either directly or indirectly related to crude prices, and whenever there is a sharp drop in crude prices, the margins of all these sectors also get a boost going forward.
All right, Sharad and Shomit, thank you very much for breaking it down for us. But let's get perspective on what's happening in the commodity markets, in crude oil, in gold and silver. For that, from Norway, the chief commodity analyst at SEB, Bjarne Shcieldrop, is joining us, along with the head of research at Nirmal Bang Securities, Kunal Shah, is with us from Mumbai. Bjarne, coming to you first, the future of crude oil prices, they seem inextricably linked with the way the Fed moves on interest rates. Why don't you begin by helping us understand that link between Fed rate hikes and how you expect the Fed's future rate action to have an impact on the price of crude oil going ahead, now that the other moving piece, the crisis in the banking sector, at least for now, seems to be cooling off a tad and risk appetite is edging back. Bjarne.
If you look at what happened with the banking crisis lately, it's of course because of 10 to 15 years with ultra low interest rates and plentiful liquidity, and then a sudden, very, very rapid interest rate hike, releasing and unfolding the banking crisis we've seen in the US and in Europe so far. And of course, this is bad for banks. And that means also it's bad for credit. And if it's bad for credit, it's also bad for economic growth. And therefore, you should revise your forecast for economic growth lower due to what has happened with the banking crisis so far. But I think, the very, very sharp decline in oil prices we have seen lately is due to a fear that this maybe could develop into something like the 2008-09 financial crisis, where demand fell by 2 million barrels per day year on year. So that is sort of what is driving oil prices lower. It's the fear of a potential big setback in demand and the financial speculators selling off the front end.
Absolutely. And even as we watch what's happening on crude oil prices, Kunal, these gold prices, they're on a high and quite a tear, actually. This is happening just ahead of Gudi Parva, which is a key Indian festival when people buy gold. So how do you see demand and price action on gold right now? Do you think we're looking at bigger highs on gold and silver?
Yes, gold and silver prices are in a structural bull run, and it is a strategic investment from the investment point of view. So we've already seen 10% move coming in last almost not even a month also. Major up move. See, the fact about the scenario, what we heard from the previous gentleman, I think the central banks are, all the central banks are right now in a big dilemma. So if they stop, hiking the rates and they go back to, again, cutting the rates, then inflation is not going to come down. And again, you are going to have a low growth. So that is bullish for gold. And in case, if they say, look, we are going to continue with the rate hikes and the monetary tightening, then the banks like this or the real estate or something or the other is going to crumble. And that is also bullish for gold. So it's a win-win scenario from precious metal point of view. And that's why I keep mentioning in your previous show also that gold and silver are right now strategic investment. More than a price appreciation, they are going to deliver when things are going south. So the gold may witness some profit taking, some correction after almost $200 of rally. But I think 1950, 1960, again, good levels on India, around 50,000, 58,000 good levels. I'm expecting by the end of June, July, gold to test $2,150, $2,200 on COMEX. And in India, it will translate into, with currency around 81, 81.50, it should translate to somewhere between 61,500 to 62,000 rupees.
So that's a good range that you're offering us. It seems like it's going to be a high and strategic investments right now when you're trying to hedge risks. But Bjarne, do come in on this. As far as the Fed's possible rate hike is concerned, we don't know yet whether it's going to be a rate hike. 25 basis points is a likelihood now. Also, a pause is a likelihood. So in those two different kind of scenarios, Bjarne, how do you think the markets, the commodity markets, are going to react going ahead from here at a time that we're seeing crude oil prices come under pressure and gold and silver prices going on the rise?
I mean, I deal mostly in oil markets, but also in the other commodities, of course. But I think there is a fear of falling oil demand by what we saw in the global financial crisis. But so far, what we see is actually that oil demand is ticking higher. I mean, jet fuel demand is still like 2.3 million barrels per day below 2019 level, and it's ticking up by 100,000 barrels on a bi-weekly framework. So we are ticking higher, and so oil demand could actually, unless we move into a global financial crisis, which we don't think we will, global demand could actually increase by a couple of million barrels just due to normalization of aviation and flying. So there is a lot in store for oil actually on the upside, and so far it's the fear selling oil down rather than the actual fundamentals, because last week we saw inventories in the US actually decline, and Saudi Arabia is out saying, be aware of a very, very tight balance in the oil market, and Saudi is producing above normal levels. But of course, what will happen when Fed lifts the rate further? I think much will depend on the language that the Fed sort of accompanies a rate hike. Probably they will lift with 25 basis points. But they will probably have a very careful language rather than aggressive language, and it shouldn't be too hurtful on the global economy growth elements like copper and oil.
Fair enough. Kunal, how do you see the rise in gold prices and the fall in crude prices impact our markets? Already the OMCs, the oil marketing companies, those stocks have been moving up nicely. The markets, meanwhile, have been under pressure, and yet those stocks have climbed. Which are the pockets in the markets that will do well in this kind of scenario, especially once the Fed announces its decision on the rate hike?
Okay, so first, my expectation is that Federal Reserve may not hike the rates. That is what I'm expecting. I don't know what actually, but my assessment is looking at the way right now the crisis has started to spread in the banking. That is the heart of all economy. Why everything is going down right now? Like oil is going down, metals were going down, stocks are going down. Why? Because the crisis is spreading into banking sector. They cannot afford to. So the big dilemma for them is, if they stop, the inflation is going to move up. But no, if you look at what is happening with the gas prices, look what is happening with the oil prices. So not necessarily, because the growth projections are going to be bad. There is not going to be any major rally. There are going to be pullback or the bounce, whatever you say. But I'm not expecting other commodities like oil, metals to sharply rally from here because of the weaker growth, because of the China not going to grow like the way it used to. So we are not going to see any major rally in industrial commodities, but safe haven instruments like gold, where the central banks themselves are the buyers. So these kind of commodity are going to do well. And as far as the other part is concerned, going forward, how I see the world, how things are going to unfold from here, I think the markets will discount the future well in advance. And the future, the way I see it, the inflation is going to go down, not to 2% in the developed world, maybe at US at 5%, Europe at around 6.5%, 7%, that kind of numbers, what you are going to see next 3-4 months. And markets will discount that, and there will be a point where the things will stop falling. So even from the stock market point of view, things are not going to be like a free fall and it will keep going down. I think markets will somewhere, in next 15-20 days will find its floor, and commodities are not looking very bullish. Gold, silver will continue to do well, and things are not going to be as scary as it seems right now. There is going to be a light at the end of the tunnel.
So what you're saying is that there will be volatility, but there won't be any secular move towards any one side. Bjarne, I wonder if you agree with this, but a lot of global trade as well is in oil, of course, and there is this downtrend in the use of the US dollar to conduct global trade. Even India, for one, is trading with several countries in the Indian rupee. So if the US dollar is less of a safe haven than it was, will it be advantage gold for some time? And because of that, are we likely to see gold prices continue to rise?
I think gold is in a good position right now. And remember that since the start of 2020, US inflation so far is like 15%. And the increase in the monetary base was like plus 30%. So even if inflation is now falling back and is not as growing as strongly anymore, we're still having very elevated levels of inflation, so that the cumulative inflationary impact since the start of 2020 will continue higher. And just adjusting for like 15% inflation so far, a normal gold price in US dollar is probably around 2,100 and 50, something like that. So, with the fear in the market, we've seen longer interest rates falling lower, and that is usually positive for gold price as well. But I think in terms of oil prices and the potential downside and upside, there's been a lot of talk of the US government buying oil at sub 70 to fill up their strategic petroleum reserves again. And that could very well create sort of a buffer zone for oil prices at $70. And also most OPEC countries are producing at very high levels, and they might decide to cut production if prices fall under $70. So I think we see a lot of reaction in the oil market today, where buyers come in at just above $70 and prevent the oil price from falling further. So could be a support zone around the $70 barrel mark.
Well, a lot was pegged on the Chinese economy now opening up again, and that is where we saw a lot of demand, pushing up the demand for crude oil, and then prices moving up as well. But that hasn't happened, and then in the midst of that, we have a banking crisis unfold, which has really queered the pitch as far as crude oil is concerned, and we'll have to see where it goes, because those prices have hit a 52-week low. How much lower? They're going to slide on that slick slope, especially after the Fed announces its decision on a rate hike or not. That is something we will keep tracking with experts like Bjarne and Kunal. Thank you very much for joining us on this edition of India Tonight, gentlemen. Great having your thoughts and perspective on the show. Appreciate it.